Well, good morning and welcome to the Solaris Long Short webinar on what does 2019 bring for Australian long short investing. My name is Mark Cormack and I'm a director with Pinnacle Investment. Pinnacle works alongside Solaris to distribute their investment management capabilities to the Australian financial advisory marketplace. As we are at the start of the Australian companies reporting season, Damien, Keune and Gus Roberts from the Solaris Long Short team will take you through the opportunities and threats that we see in the Australian equity market and how they have positioned the portfolio to deliver returns for you and for your clients. Just in terms of background, Solaris are a fund management boutique who have an 18-year track record of managing Australian equity portfolios. Solaris adopt a style-neutral approach to investing in Australian equities, meaning that they're neither value or growth. And this approach has enabled the Solaris team to outperform the Australian equity market in 16 out of 18 years, which is a track record that most fund managers envy. Like all the boutiques within the Pinnacle stable, the Solaris team own the majority of equity within their fund management business. But equally important is that they have a stable investment team who have been working together for well over a decade. In terms of performance, I'm delighted to say that the team's outstanding track record has continued with their long-short strategy, delivering well over 7% per annum outperformance over the index since inception. The fund also has a highly recommended research ratings from the likes of Zenith and a recommended rating from Lonsec, which is a great endorsement and recognition of the team's consistent investment approach, delivering outperformance over the Australian equity market. Before we start today's presentation, just a reminder that all attendees have the opportunity to ask questions. This can be done via the internet by clicking the questions tab chat box on your screen. So without further ado, I'll hand you over to the Solaris Long Short team of Damien, Keune and Gus Roberts for today's presentation. Thanks, guys.
Great, thank you, Mark. So if we can just go to the first slide, or the next rather. For anyone new, I thought I'd give you a quick bit more detail about Solaris. So we are a style neutral manager who picks stocks using bottom-up fundamental analysis to help exploit market inefficiencies in forecasts and valuations. Style neutral means that growth, value and many other factors can be the source of investment returns, both long and short. We are an experienced team who have been investing together for well over a decade, and we have 7 empowered analysts who are the experts for the stocks within the allocated sectors. And this is where we are a little bit different to our peers. We think the analyst, rather than a single PM, is best placed to weigh up an investment as they are most familiar with the stocks. This chart here highlights our objective of our long-short fund quite well. It is an extension fund. It leverages off of our flagship long-only core product. So it's utilising all the same IP and the same investment process. As that previous slide detailed, our core fund has a long history of consistently delivering alpha year in, year out. And with our long-short fund, we are able to amplify these consistent returns through shorting and monetising our negative views. Shorting then also provides the low-risk capital to reinvest into our high-conviction long ideas, grossing up the position sizes, which further add alpha to our investors. So with that, I'll now pass over to Gus for today's topic of opportunities and threats.
Great. Now moving on to the next slide, opportunities and threats and the resurrection of market volatility. And after an extended period of steady equity returns, volatility has returned to equity markets. You don't have to look too far to get a good understanding of what investors are currently grappling with, whether that be Brexit, oil sanctions, trade wars, Trump and his wretched Twitter account, and domestically the Royal Commission, housing-related fears, and of course our own political uncertainty. To say it has been a stomach-churning ride is probably understated, and these wild swings can really rattle even the most seasoned investor. We think it's therefore really important just to keep some perspective, and that is that volatility is a normal part of investing. Downturns, while they can be sharp and violent, they're normally short-lived, and we think it's also really important therefore to take advantage of opportunities. And finally, timing the market is actually really hard. It's something we don't advocate, and we think it's a real trap for investors trying to pick market turning points. We Certainly agree with Peter Lynch, the famed investor and author of One Up on Wall Street. So where are we today? Well, after the recent pullback, we've actually closed some shorts, and we find ourselves selectively topping up some of our high conviction names that have suddenly become a lot cheaper. So overall, we believe market volatility is here to stay, and in an effort to guard against market volatility, we believe it is sensible that investors look towards strategies that are both flexible and seek to dampen downside risk. So in our long-short fund, we seek to offer higher potential returns than a long-only product, and that is across all market conditions. So the objective there is to not only outperform during bull markets, but also offer some protection during downturns.
And on to the next slide. That protection could come in the form of shorting. At Solaris, we recognise that not all shorts are equal, and different shorts should serve a different purpose depending on the market cycle. This is a very important point because not all shorts will offer the same protection in a market sell-off. So how do we short at Solaris? Well, each position or each short position is classified as either an outright short, a paired trade, or a funding short. And now we categorise the shorts for two key reasons. So firstly, it helps us to manage risk. So everyone knows that risk comes in all shapes and forms, but specific to shorting, it helps us avoid concentration risk or short squeeze risk. And then secondly, it helps to broaden our alpha stream. So categorising shorts opens up a much larger shorting universe. It allows us to put more emphasis on the short category that we think is more relevant for the cycle. So on to the next slide. We believe the most effective short category to help provide that protection in a correction are the outright shorts.
So outright shorts, these are your more traditional event-driven shorts, and in the past, certainly during the market rally, they have been less significant in a performance sense than the funding and pairs trades. More recently, this has changed, however, and we've had a lot of success trading the outright shorts more recently. This strategy has significantly protected the portfolio throughout this period of uncertainty. So what are outright shorts? Pretty simple. They're stocks we expect to fall in value. They likely fail one of our initial financial, geopolitical, ESG or litigation screens. They have earnings risk or are simply overvalued. Typically, they're shorter shelf life, they're higher turnover trades, and these are your more catalyst-driven shorts, and events such as reporting season, AGM season, or a market correction can be really fruitful from an outright sense.
Yeah, the outright shorts are typically lower quality companies, which we expect will fall even more in a market correction. So some outright shorts that we have had some success in over the last few months include examples such as Ainsworth Gaming, Mortgage Choice, or even Keune, of which we've now taken profits in most of these. But we will be the first to recognise that such outright shorts are a riskier proposition, and now that valuations are looking much more attractive and these shorts have served their purpose, we have rotated or skewed the short portfolio back into those lower risk funding shorts.
Now, if we move on to the next slide, funding trades, the lower risk funding shorts, they really provide the cheap capital so we can gross up stocks we actually want to be long. The hurdle for success here is much lower than the outright trades, and these are stocks that are just expected to underperform our conviction long ideas. Perversely, they may actually go up in price, but it's not as much as our preferred longs. And the characteristics of funding shorts, they're sleepy, they're boring, they're more pedestrian style stocks, and we don't expect to get blown up from the shorting sense. So we're also able to take a multi-year view, and they're generally lower turnover.
But in some examples, these funding shorts can provide much more than the cheap capital to reinvest into a high conviction long. So some funding shorts can add alpha in their own right. So we've used Coca-Cola and Adelaide Brighton as two examples here.
So we look at Coca-Cola. We've essentially been short Coca-Cola since the inception of this fund, and we believe it is a structural short. We acknowledge that supermarket competition has probably become a little bit more rational over the last year, but there's several other large negatives that still remain, such as the structural decline of soft drinks and, of course, the Indonesia risk. Cokes is currently trading at about 16 times forward PE. That's sort of broadly in line with historical averages, but we see continued earnings downgrades as the catalyst for further underperformance from here. Cokes are set to report their financial year 18 result on the 21st of February, and we remain pretty cautious.
Adelaide Brighton, the second example. So we've been short this stock now for the last 12 months. The initial reason for the funding short was purely valuation. So after a long period of stable earnings and reliable dividends, including specials along the way, the stock re-rated to what we thought was an unrealistic 20% premium to market, and this is where we actually initiated the short. And then we actually increased the short with the departure of a couple of key executives, so namely the CEO and the CFO. But remember, we only needed Adelaide Brighton to underperform our conviction longs for this short to add value to our process. But at the time that we have been short the company, they delivered an earnings downgrade, which served to remind investors that this business is indeed a cyclical business with some volatility in their earnings. Now, after a substantial derating, it's trading back at a 20% discount to market, along with a new CEO and CFO appointment. We think the share price is probably factoring in the worst now. So we don't believe this business is broken, so we have recently closed this funding short.
And in both of those examples, Damien, the shorts are large caps, so they're liquid, they're not crowded from a shorting sense, so they're lower risk, and they're certainly easy to borrow. And quite simply, they're just providing that cheap capital that we can reinvest into our preferred longs. And actually, in some of these examples, they can provide a great source of alpha in their own right. Now, if we move on to the next slide, let's take a look at a couple of stocks that are looking cheap to us and are key long positions for our funds. So two examples we're going to look at today, the first being James Hardie. Now, James Hardie, like the rest of the building material space, has suffered an extraordinary derating, as can be seen in this chart. It's now trading at a decent discount to the market for the first time in over a decade.
And this pullback is certainly on the back of a number of investor concerns, which we think are largely short-term issues and should be resolved in the coming 12 months, Gus.
Yeah, so the first one was that the long-standing and really well-regarded CEO, Louis Gree, he officially handed over his reins to Jack Truong at the third quarter results on Tuesday, just gone. So prior to that, many had speculated the group's strategy would actually change under Jack's leadership. However, in our discussions with management and board, they have sort of provided us confidence that the company is going to remain focused on the current strategy of driving market share growth. And secondly, which is probably the main reason for Hardie's share price decline, has been mixed results delivery over the last couple of years. What we've seen is that as James Hardie have ramped up their manufacturing capabilities to meet US housing demand, there's been some commissioning delays and also some cost overruns. That's impacted their supply and allowed competitors to gain some ground there. We now believe most of these issues are behind them, and the remaining ones are short-term and fixable. And post the result on Tuesday, there is evidence that the CEO remains very focused and incentivised to get back to their targeted market share.
And then from a macro perspective, and we are certainly not economic forecasters, but from a macro perspective, the market is also anticipating a softer year in US housing growth. We just think it's worth remembering that the long-run number of US housing starts back to the 50s is sort of circa 1.5 million homes per year. And since the GFC, the annual rate has been slightly inching up from around 450,000 starts per year to around 1.25 million starts today.
And so what we're saying there is, US housing market still operating well below long-term averages. And actually what we've seen more recently is mortgage rates in the US have dropped significantly with those bond moves, and it's actually a lot more affordable to get into the market at the moment. Some of the other risks are that margins have been hit by historically high pulp prices. This has actually started to reverse and could become a tailwind. and also the performance of the European fibre gypsum business, Fermacell. That was acquired last year by James Hardie.
So we think the valuation discount here provides a large enough safety net for all of these risks, and we've actually used the share price weakness to top back up our position size.
Now, if we move on to the next slide, this is our second example, Aristocrat Leisure. Aristocrat is a stock that we've owned in the past, and we actually think this recent sell-off is overdone and has gifted us an opportunity to revisit again from the long side. As you can see there, Aristocrat is currently trading at a 20% discount to the market. This is the first time in almost a decade, and it's really hard to reconcile given the growth outlook of this company.
So the recent weakness here in the Aristocrat share price, I suppose, is at least partly due to concerns around the performance and sustainability of their social gaming investments. So this sector is huge and growing, but the market is concerned with competition and if Aristocrat indeed have the scale product or even the strategy to succeed. Now, we appreciate some of these concerns, but for us, social gaming is still only a small part of our forecast earnings for Aristocrat, and in fact, some of the recent industry reports suggest that they're getting some incremental market share gains for this business. That helps to alleviate some of our fears. And then if you just look at their core business, they remain a market leader in the design and manufacture of slot machines and game content. And then through increased investment to R&D and acquisitions, the company has grown its market share of slot machine markets, and now they're successfully leveraging that content online. They have an AGM trading update coming up on the 21st of Feb, and we don't expect management commentary to vary too much from the outlook provided in November for continued growth into financial year 19. So with almost 15% earnings growth forecast for the next 3 years, we are happy to take advantage of these multi-year low valuations and add Aristocrat as a high conviction long to our portfolio.
Thanks, Damien. So let's move on to the next slide, the market outlook. So where to from here? Well, the environment has changed quickly, as we all know, and last reporting season in August, it was surrounded with significant optimism, which was quickly followed by a steep sell-off in the markets and also market-wide downgrades. We've seen earnings growth estimates. They've been cut from, above 10% to 6% today. And the market PE also peaked in August at 16 times and then quickly fell to 14 times, which has entered, cheap territory, I guess. While it's only early days, it is evident the market is not priced for good news, and inline results should be enough to see stocks move higher. On the flip side, we do believe there are some stocks where the E or the earnings is still probably too high and earnings need to be reset. So with markets retracting strongly at the end of 2018, the question is, are there any shorts left to make money from? We think the answer quite simply is yes, and even though we've taken profits in many of the outright shorts, we are still selectively shorting companies in the outright category that we believe have earnings risk. This is especially the case given the market has now had a good rally from the lows. We also have no problem with the fact that funding shorts now make up the overwhelming majority of our short portfolio, and these shorts are low risk, as we've mentioned, and don't have to outright fall from here to add value to the process. Just to reiterate, their job is to provide the cheap capital so we can gross up the long positions such as James Hardie and Aristocrat we've mentioned and take advantage of some oversold valuations.
So that concludes our presentation today. We think with the right approach to shorting, opportunities will always be plentiful and can provide good downside protection and a valuable source of alpha. I'll leave you with our performance as at the end of January, and we'll draw your attention to the 4 buckets, which is how we measure performance. That's across our 3 shorting categories and the performance of the underlying long core product. I'll now pass you back to Mark, and thank you very much for your time.
We do have a number of questions that have come in terms of your views on reporting season. We've got a couple of questions kind of around that. If I give that one to you, Damo.
Yep. Okay, so I suppose we'll try and wrap up a couple of these questions in one then. The first point is that it's clearly evident in the early stages of the reporting season that volatility is going to be a prominent feature. Strap yourself in. So like Gus mentioned before, expectations have been reset a lot lower. So earnings have been downgraded from about 6%, from 10% to 6% in the last 6 months. So expectations are a bit lower. And if we have a look at some of the the few examples of companies that have derated into their results and then reported, we've seen some huge relief rallies. So what's some examples, Gus? We have James Hardie to start with. That was trading on about 8 times ahead of their result, with a dividend yield almost the same as its multiple, around 7%. Clydesdale, another example, was trading on, I think, 6.5 times. It had a dividend yield of around 6% as well. Since they've reported, the share price is up around 5% and 15% respectively on some relief. Hardie's, as we mentioned, that was trading at a decade low PE before their results. I think they're up now close to 10% since reporting. But it's not all about relief rallies either. Boral, they were priced for a downgrade and shareholders certainly got it. So that sent the stock another 10% lower on the day. And then if we have a look at an example like IDP Education, which reported yesterday, that stock was certainly priced for an upgrade on that multiple, yet it rallied another 20% on a much more modest upgrade. So I think in summary, as you would expect, it's all about earnings momentum this month, with positioning and valuation probably a bit more front of mind for an inline result.
Very much so.
Excellent. Okay, guys. We got a couple of questions I'm going to combine here around the consumer, retail, housing, etc. Banks. Any views there?
Yeah, again, this question covers quite a lot, and rightfully so because it's all related. So very broadly, look, no doubt housing and the wealth effect is impacting consumer confidence. So for the retailers, there's every chance of less discretionary spend. You know, we've already seen several downgrades now from some of the auto retailers, and that industry retail trade data that came out for the last 6 months show continued weakness, particularly in the furniture and electrical categories. For housing, we are seeing evidence of a construction slowdown. So residential approvals are down sort of circa 25% from their June highs, and that will no doubt impact the building material companies, also those fixture and fitting companies like GWA. Regarding the banks, you know, we have seen some relief rally post the Royal Commission, but in summary, that's because it just wasn't as bad as feared. And look, while you know, it wasn't enough to resolve the credit rationing issues that we still read about in the press, it probably does provide some framework for the banks to at least lend again with a bit more confidence.
It all sounds pretty grim then, Damien. Like, yeah, is there any good news out there? Or
Well, it does sound pretty grim. In terms of portfolio positioning, look, there's a lot of value out there in these domestic cyclical stocks, and most of them are already heavily shorted or it's a consensus underway. So you'd probably argue, Gus, it's pretty hard to put that same trade on here.
Yeah. We typically try to really avoid that crowd mentality. You can really open yourself up to a short squeeze risk, which we sort of try and avoid. And in saying all that, we do think there are a couple of outright shorts, but you just need to be really selective in that space, because you open yourself up to some of those other nasty risks. That probably answers that one.
Okay. Look, while we're talking banks, what's your view post-Royal Commission and any preferred exposures there? We've got a couple of questions on that.
Yeah, so without maybe outlining the various recommendations made in the Hayne report, I think there were 76, but as Damien sort of mentioned, in summary, they were probably in line with expectations, not as bad as feared, and it's been a pretty busy year, high drama. There's been some shocking cases of widespread corporate greed, but in the end, the report was pretty logical and avoided any of those worst case scenarios. As Damien mentioned, the banks, we've seen a big relief rally, and that's because the banks have sort of already started to implement some of their recommendations. They've also had a huge derating over the last year, so it wasn't a huge surprise. Within the sector, CBA and Westpac, they should benefit the most given the mortgage broker recommendations and also a lack of a need for structural separation. And then maybe NAB on the flip side there is the relative loser given the commentary over, a real lack of confidence. And, overnight we've seen the CEO and the CFO both fall on the chairman, fall on their sword, and that was just bowing to pressure there.
And it's good to see that was addressed really quickly, to be honest, too.
Yeah.
Other point is Macquarie. They've emerged as a responsible corporation with its reputation intact.
Yeah, and I guess furthermore on those wealth managers, AMP and IWF, they also witnessed quite significant relief rallies. However, with those two, we actually remain pretty cautious. They've still got a long way to go in terms of building trust and brand. That can take a long time. There's still a lot of question marks over their business model. They're battling increased regulation and costs and potentially facing criminal and civil proceedings. What else to cover off?
Independent platforms.
Yeah, so net wealth and the hubs. Net wealth certainly initially sold off, and I guess that's because investors are a little bit disappointed of a lack of more stringent regulation on some of those vertically integrated players. Over the medium term, though, we believe some of those trends, the recent trends towards the independent players, is going to probably continue, and just because of the increased regulation on the industry as a whole.
You mentioned mortgage brokers as well. They were obviously the big, the ones that were most negatively impacted.
Yep.
But we've all read about that in the press.
You guys had a short on Mortgage Choice at one stage?
At one stage, yes, which worked well in protecting the portfolio.
Yeah. And then Link, saw a little bit of weakness as a result of some of those recommendations to implement one superannuation account as default. Now, that wasn't a surprise. That's been talked about over a long time. And at the end of the day, we believe Link are part of the solution. We believe the momentum towards industry funds and away from retail funds is going to continue, and believe that's going to benefit Link over the medium to long term.
Probably that's a good summary.
Yeah, pretty comprehensive. Okay, guys. Bit of a broader question here. A lot of people are talking about growth and value at the moment. Where do you think your biases have helped you guys compared to other fund managers? Because there's been some pretty average performers out there in the last 12 months.
Yeah, that's a good question. We've been sort of happy to grind out sort of performance. I guess where we're sort of situated, we're modestly overweight growth at the moment. We've actually increased that weighting through December with the sell-off. But honestly, it hasn't really been any style bias that has influenced our performance. And we really actively try to manage our portfolio in that way and try to remove as much styles from sort of dictating performance there. We sort of don't take any such sort of growth value or some of those other styles, international, domestic, large cap, small cap, cyclical defensive tilts. We're really aware of that and try to reduce that where we can. And it's really our stock picking that we live and die by, and is going to continue to drive performance. And back on that performance slide, as that sort of detailed, the source of our outperformance has been pretty broad. It's a mixture of our core fund, our longs driving some performance, plus also a really diversified short portfolio. So the outright trades, as we've mentioned, have done really well in this market sell-off and protected the portfolio, but also the lower risk pairs and funding trades have considerably helped the portfolio as well.
Fantastic, guys. Look, that's all we have time for today, so we will have to wrap up our presentation. Look, we haven't got to any of your questions. We certainly will reply. We will be making this webinar available on the Solaris investment website, which you can see there on your screen, solariswealth.com.au. We'd like to thank everyone for their participation and questions today. If you do have any further questions, please do not hesitate to contact one of the Pinnacle distribution team. We certainly look forward to speaking with you either on our next webinar, next meeting in your office, or at one of our luncheon events. So thank you very much and have a great day.